Mutual funds are a type of investment vehicle that pools money from many investors to purchase a diversified mix of stocks, bonds, and other assets. They are professionally managed by investment companies, which use the pooled money to invest in a variety of securities. Here are some important features of mutual funds. Diversification. Mutual funds offer diversification, meaning that they invest in a variety of securities, which helps reduce risk. Instead of putting all your money into one stock or bond, mutual funds allow you to spread your investment across many different companies and industries. Diversification is a risk management strategy that involves spreading investments across multiple assets, industries, or geographic regions to reduce the impact of any single investment's performance on the overall portfolio. The goal of diversification is to minimize risk by ensuring that a portfolio is not overly exposed to any one type of asset or market condition. Diversification can be achieved in several ways, including asset allocation, allocating investments across different asset classes, such as stocks, bonds, and cash equivalents. Sector allocation, investing in different sectors, such as technology, healthcare, or energy. Geographic allocation, investing in different geographic regions, such as domestic and international markets. Investment style allocation, investing in different investment styles, such as growth, value, or income. By diversifying investments, an investor can potentially reduce the risk of losses due to market fluctuations or unexpected events that may affect a particular asset or market. For example, if an investor has all of their money invested in one stock, they are exposed to the risk of that particular company's performance. However, if the investor spreads their investments across multiple stocks or other asset classes, they may be less impacted by a single company's performance. It's important to remember that diversification does not guarantee against loss, and that all investments involve risk. However, diversification can be an effective tool for managing risk and potentially achieving long-term investment goals. It's important to carefully consider your investment goals, risk tolerance, and investment horizon before diversifying your portfolio, and to seek the advice of a financial professional if you're unsure about how to proceed. Professional management. Mutual funds are managed by investment professionals who use their expertise to select and manage the investments in the fund. This can be a major advantage for investors who don't have the time or knowledge to manage their own investments. Transparency. Mutual funds are required to disclose their holdings and performance, which allows investors to see what they are investing in and how the fund is performing. Liquidity. Mutual funds can be bought and sold at any time, making them a highly liquid investment. However, some mutual funds may have redemption fees or other restrictions on withdrawals. Liquidity refers to the ease with which an asset can be converted into cash without impacting its price. In other words, it's the ability of an asset to be bought or sold quickly and with minimal impact on its market price. Assets that are highly liquid, such as cash or stocks, can be easily bought or sold in large quantities without significantly affecting their market value. On the other hand, assets that are illiquid, such as real estate or private equity investments, can be more difficult to sell quickly and may require significant time and effort to find a buyer. Liquidity is an important consideration for investors because it affects their ability to access their money when they need it. Assets that are highly liquid are generally considered to be safer investments because they can be easily converted to cash in case of an emergency or unexpected expense. On the other hand, assets that are illiquid may offer higher potential returns, but may also carry higher risks and require a longer investment horizon. It's important for investors to consider the liquidity of their investments when building their portfolios. For example, if an investor needs quick access to cash, they may want to allocate a portion of their portfolio to highly liquid assets like cash or short-term bonds. Alternatively, if an investor has a longer investment horizon and is willing to take on more risk, they may choose to invest in less liquid assets like real estate or private equity. Overall, liquidity is an important factor to consider when making investment decisions, as it can impact the overall risk and return of a portfolio. It's important to carefully consider your investment goals, risk tolerance, and investment horizon before investing in any asset, and to seek the advice of a financial professional if you're unsure about how to proceed. Fees. Mutual funds charge fees and expenses, such as management fees, administrative expenses, and sales charges. These fees can vary widely between funds and can eat into returns over time, so it's important to carefully consider the costs before investing. Types of mutual funds. There are many types of mutual funds, including equity funds, which invest in stocks, fixed income funds, which invest in bonds, balanced funds, which invest in both stocks and bonds, index funds, which track a particular stock or bond index, and sector funds, which focus on specific industries. It's important to remember that investing in mutual funds involves risk, and there is no guarantee that a mutual fund will achieve its investment objectives or that you will receive a return on your investment. It's important to carefully consider your investment goals, risk tolerance, and investment horizon before investing in mutual funds, and to seek the advice of a financial professional if you're unsure about how to proceed.